CNBC's Christina Partsinevelos is at the NASDAQ for us. I'm also joined by Josh Barro, columnist for Insider. So, Christina, what's your read on why this rate increase, which is meant to improve the economic picture, isn't being greeted that way on Wall Street?
It's because of the tone that the Federal Reserve, our central bank, is setting right now. This is no longer a one-off. The Fed has said they're going to get aggressive right now because inflation is so high. We got inflation numbers just last Friday. We're seeing it at levels we haven't seen since 1981. And so you had the Fed chair yesterday said that they are willing to hike again just in another, let's say, month or so. And so that's concerning for markets because if interest rates keep climbing higher, that means debt is more expensive, especially for a lot of corporations that are high growth, like technology companies. The NASDAQ, the worst performer today for that reason alone. So there is concern that the volatility is going to continue because we've had such easy monetary policy for so long. This is something that a lot of people in the market, myself included, those that are, millennials and stuff, have never seen such a downturn.
You know, Josh, the immediate impact of these interest rate hikes, not just on corporations, but individuals. We mentioned mortgages, credit cards, loans. What does it mean for the economic landscape and concerns that people have just about spending money?
Yeah, well, I mean, that's sort of the point of the interest rate increases is, we have this inflation. There's too much money sloshing around in the economy, in part because of all of the payments that were made in the COVID relief packages. So household balance sheets are actually in very good shape right now. And that's part of why, even though you've had this inflation until the reports in the last few weeks, you really saw people just going out and continuing to spend in spite of higher prices. So when the Fed raises interest rates, one of the effects of that is now it's over 6% to get a 30-year mortgage. We're seeing a significant cooling in the housing market as a result of that, and some of the unsustainable increases in home prices and rents will hopefully have a cap put on them. Similarly, the car sales have been cooling off somewhat because this pushes up the cost of a car loan. And so obviously that's unpleasant at the household level. But that's kind of the objective that the Federal Reserve is pursuing here. If you're going to have reduced inflation, you need somewhat reduced consumer enthusiasm to go out and try to buy up more products and services that are actually available in the economy. And that's working through the interest rate channel. And then also because it affects the stock market, one thing that happens is people look at their retirement account balances and they say, that's a lot lower than it was a few months ago. Maybe I won't take that vacation. Maybe I won't go buy that new car. It's another channel through which we get a little bit of cooling on the inflation, but it's not a very pleasant channel.
Well, let's talk about, Christina, those folks who are close to retirement or maybe even in retirement. This is the kind of thing that keeps you up at night, right? And we always hear, hang tight, the market always comes back. But if you need to be living off of your savings right now, or you're close to having to live off your savings, this is not good.
No, unfortunately not. At CNBC, we have this survey that goes out, and it just came out today. It's called the Millionaire Survey. And according to the ones that we pooled, they believe that we are headed for a lot worse for the next 1 to 2 years in terms of inflation, possibly a recession. That, kind of goes against the younger generation that believes that inflation will start to cool in the next 6 months. So for those that are nearing retirement, yes, it is concerning. You got to think maybe I should be rebalancing my portfolio. If you have a home, I know the home sales are starting to cool, but it's still a market for sellers. So consider selling your home right now. A third point, too, is consider having a little bit more cash on the sidelines. Don't pay attention to the day-to-day headlines that markets are selling off today. And then maybe consider really securing that job as the labor market starts to cool. We're starting to see it ever so slightly in the technology world as people are, instilling hiring freezes and laying off employees. So could be very volatile for the next, 6 to 12 months even.
And 6 to 12 months, Josh, puts us squarely in decision time for folks who think they want to run for president.
Absolutely. And I think, as President Biden and the Democrats look at this, inflation is their number one political problem. At this point, inflation is still going to be a terrible problem by the time the midterm elections roll around. I don't think there's any hope of having, material improvement by then. They really need to be focused on material improvement for 2024. Some of the things that they're doing, we still have this moratorium on student loan debt repayments, which is the equivalent to a $60 billion a year fiscal stimulus. All the other fiscal stimulus from COVID is over, and for good reason. The acute pandemic is over, and we are no longer, the economy no longer needs to be stimulated. It's overstimulated. So the administration needs to find a way to end that. They need to support the Federal Reserve as it seeks to contain inflation. And there are other steps that Biden can take to reduce inflation, like he could lift some of the tariffs that he's still imposed, that Donald Trump had imposed as part of Donald Trump's trade policy. They're not issuing all the immigration visas they could issue. That's part of the problem in the labor markets right now. One of the drivers of inflation is really hard to hire work. We were issuing more visas, bringing more workers in. That's something that would take pressure off inflation. President Biden put out a letter this week to oil refiners saying, what can we do to get you to put more capacity online so that will bring gasoline prices down? Letter came back from ExxonMobil saying, please waive the Jones Act, which is a rule that restricts how you can do shipping of products, including oil and oil products, and approve more pipelines, approve more oil leases. That's not going to get more gasoline out into stations in the next 6 months, but some of that, the leasing, maybe not the pipelines, could have effects before the 2024 election. So if I were Biden, I'd be looking very seriously at what are all the levers I have that can get this inflation to start coming down in 2023, like the Fed is forecasting that it will, but it's going to take a whole bunch of different policy responses. That's what he needs to do if he wants to be reelected.
Josh Barro, Christina Partsinevelos, thank you both.